There's a guy I know who invests like he's grocery shopping while hungry. He buys whatever looks familiar, sells whenever it feels uncomfortable. No spreadsheets, no earnings calls, no macro thesis. Meanwhile, his friend who actually understands finance has 5 tabs open, a podcast in his ear, and a mild panic attack every time Jerome Powell clears his throat. Fast forward 10 years. The dumb guy somehow ends up calm, boring, and richer. The smart one? Burned out, overtraded, and still convinced he was this close to being right. That's the uncomfortable part. Because if investing was really about intelligence, the outcome should have been obvious. But it wasn't. And that's where things start to feel off. So here's the question. Everything else in this video quietly revolves around: why do investors who look less intelligent, less informed, less active, less serious, so often end up with better long-term results than the ones who know more, study more, and try harder? Not occasionally, not by accident, but consistently, across decades, markets, and generations. This isn't a question about luck, and it's not about cherry-picked success stories either. If anything, it's more unsettling than that because it suggests that something we assume is an advantage in investing might actually be working against us. But we're not answering that yet. First, we need to talk about what almost everyone already believes and why that belief feels so reasonable. Let's be fair to the mainstream belief first because it makes sense. Most people believe better investors win because they're smarter. They read more. They analyze more. They react faster. In almost every other area of life, that logic holds up pretty well. If you want to be a better doctor, you study more medicine. If you want to be a better lawyer, you understand the law deeper. If you want to be a better athlete, you train harder and optimize everything. So naturally, investing should work the same way. The more information you have, the more angles you understand, the more active you are, the better your results should be, right? That belief doesn't come from arrogance. It comes from experience. We've all seen stories of legendary investors who were obsessively analytical. We've all heard phrases like do your research and know what you own. And honestly, ignoring investing completely does sound irresponsible. So when someone says, actually, the less you touch your portfolio, the better you might do, it almost feels lazy, or naive, or dangerous. And that's why this belief is so powerful, because it's not stupid, it's logical, it's intuitive, and it's exactly what makes the next part so uncomfortable. Here's where the illusion starts to crack, because when researchers stopped listening to what investors said and started looking at what investors actually did, the results were awkward. Over long periods of time, the average individual investor consistently underperforms the market. Not by a little, by a lot. And no, it's not because they picked bad assets. It's because they touched them too often. Study after study shows the same pattern. The more frequently people trade, the worse their returns become. Not beginners only, not emotional gamblers, even professionals. In one famous data set, the investors with the best performance weren't the smartest ones. They were the ones who forgot they even had an account. Some had literally passed away. Their portfolios quietly outperformed the living. Dark? Yes. Accidental? Also yes. But impossible to ignore. Here's the uncomfortable logic. Every decision feels intelligent in isolation. Selling to lock in profits, buying after good news, reducing risk when things feel uncertain. But markets don't reward smart moments, they reward boring durations. The problem is that intelligence doesn't make you patient, it makes you confident, and confidence increases activity. Activity increases friction. Friction creates mistakes, taxes, fees, bad timing, emotional overcorrections. None of these show up in spreadsheets when people plan their strategy. They show up quietly over years. And here's the strangest part. The market doesn't punish ignorance. It punishes interference. Doing nothing feels irresponsible, but doing something, especially when you feel smart doing it, is often exactly how long-term damage happens. That's the illusion. The belief that being more involved must mean being more effective. In investing, that assumption quietly flips on its head. What makes this even more unsettling is that this pattern isn't new. It didn't start with Robinhood. It didn't start with CNBC. It didn't even start with computers. If you zoom out far enough, financial history reads like the same story told with different costumes. Every era has its smart money, and every era has a moment where that smart money becomes too active. Take one of the earliest modern market crashes. In the years leading up to it, investors weren't stupid. They were informed. Newspapers printed market prices daily. People discussed stocks at dinner tables. There was optimism, innovation, and a belief that this time was different. What followed wasn't caused by ignorance. It was caused by overconfidence. Too much conviction, too much leverage, too much reacting to short-term noise. Fast forward a few decades, and the pattern repeats just louder. During the tech boom, investors weren't guessing. They had data, user growth, revenue projections, experts explaining why traditional rules no longer applied. The problem wasn't lack of intelligence, it was too much faith in intelligence. History keeps teaching the same structural lesson. When markets reward patience, humans try to optimize speed. When markets reward time, humans try to predict timing. And that mismatch never goes away. What's fascinating is that the biggest long-term winners in each era often looked boring in real time. They weren't the loudest. They weren't the most quoted. They weren't constantly adjusting. They stayed invested while others explained why staying invested was irresponsible. That doesn't make them heroes. It makes them passive, which sounds unimpressive until you realize how rare it is. Because in every generation, there's pressure to do something, to respond, to adjust, to prove you're paying attention. History suggests that markets don't reward attention nearly as much as they reward endurance. And that's an uncomfortable thing to accept, especially in an age where doing nothing feels like falling behind. Let's strip the finance jargon away for a second. Imagine two people trying to get in shape. One weighs himself every hour, counts every calorie, changes his workout routine every 3 days based on how he feels that morning. The other just walks every day. Eats roughly the same food, doesn't overthink it. A year later, guess who looks healthier? Investing works the same way but with way more temptation to interfere. Checking your portfolio daily is like checking your height every morning. Nothing meaningful changed, but your mood did. And once your mood changes, behavior follows. Here's another comparison. Think about driving on the highway. The worst drivers aren't the slow ones. They're the ones constantly switching lanes because they think the next lane is slightly faster. Each move feels smart. Each move saves 2 seconds, until one bad merge wipes out all the progress. Markets punish lane switching the same way. Now let's talk about information, because this is where people get defensive. More information feels like control. News, charts, alerts, opinions. They all create the illusion that you're steering the outcome. But most market information is like weather updates from 5 minutes ago. By the time you react, the market already moved. So what does extra intelligence actually do? It gives you more reasons to act. And action is expensive, not just in fees or taxes, but in timing errors. Selling after fear feels rational. Buying after confidence feels justified. But emotions don't line up with future returns. They line up with recent experiences. Here's the ironic part. The dumb investor isn't calm because they understand markets better. They're calm because they don't engage with markets as often. Less engagement means fewer emotional spikes. Fewer spikes mean fewer forced decisions. Fewer decisions mean fewer chances to be wrong. It's not discipline through willpower. It's discipline through distance, like keeping junk food out of the house instead of relying on self-control. And over long periods, that distance compounds. Not because the investor is smarter, but because they gave themselves fewer opportunities to sabotage progress. That's not laziness. That's accidental wisdom. So let's come back to the question that's been quietly sitting underneath everything. Why do investors who look less intelligent so often end up with better long-term results? After everything we've walked through, the answer starts to feel uncomfortable. Because it's not that these investors understand something profound that others don't. It's that they avoid something most others can't. They avoid constant decision-making. When you're highly informed, every market movement demands a response. Every headline feels relevant. Every fluctuation feels like a signal. You're not just holding assets, you're constantly judging them. And judgment creates pressure. The dumb investor escapes that loop. Not because they're disciplined, not because they're stoic, but because they're detached. They don't ask, is now the right time? They don't ask, should I reduce exposure? They don't ask, what does this mean? They just hold. And in a system where time matters more than timing, that behavior quietly wins. But here's the twist. This doesn't mean intelligence is bad. It means intelligence is dangerous in environments where action is optional, but consequences are permanent. Markets don't reward correctness in the short term. They reward survival in the long term. The irony is that the more seriously you take investing, the harder it becomes to leave it alone, which makes the original question misleading. It's not that dumb investors win. It's that investors who interfere less often by accident avoid the traps intelligence keeps falling into. And that's not a satisfying answer, but it's an honest one. Here's the part that lingers after the video ends. If markets rewarded effort the way school does, the hardest working investors would always win. But markets don't grade on effort, they grade on behavior over time. And that's deeply unsettling, because behavior is harder to optimize than intelligence. You can always learn more, read more, analyze more. But not acting when everything in your brain tells you to act? That's a different kind of skill. Or maybe it's not a skill at all. Maybe it's an absence of urgency, an absence of identity tied to being right, an absence of the need to prove you're paying attention. The market doesn't care how informed you feel. It doesn't reward confidence. It doesn't punish boredom. It just compounds whatever behavior you repeat the longest. So the uncomfortable thought isn't that dumb investors are secretly smarter. It's that, in a system built on time, the biggest advantage might simply be staying out of your own way. And once you see that, you start noticing how much of modern investing is designed to make that harder. Constant updates, constant opinions, constant reasons to intervene, which raises a quiet, unresolved tension. If doing less often leads to more, how much of what feels responsible is actually just noise? That question doesn't have a clean answer. And maybe that's the point.